Good afternoon, traders. Or did I just say good afternoon? Good morning, traders. This is Blake Morrow, and I'm going to be taking over this morning because Dale is not here today. He is out, not for medical reasons. Well, it's for medical reasons, but not for himself. He's helping out a family member, and he'll be back tomorrow, just going to an appointment, things like that. So he's out today, which is fine. You know why? Because today is going to be probably one of the better days to go out and pick weeds or rearrange your sock drawer, maybe go into the pantry and, reshuffle around the cans of beans and corn that you have in there. That's probably not a bad suggestion either. Doing things like that is going to be a good idea just based on what we're seeing here in currencies. You'll note that we have just a lot of consolidations happening. There's the euro, there's the cable. These are hourlies. There's the Aussie, there's the Kiwi, just, a bunch of consolidation going on. Euro's trading kind of heavy right now as we hit lows of this session. One of the things that, I look at as far as the euro dollar and what, how have we gotten here is, remember, the euro had a false breakout, right? Last week, we had a false breakout last week. So it's naturally going to trade a little heavy. Sorry, I didn't mean to yawn on you guys. Obviously we're going into tomorrow. Tomorrow's going to be a big deal. And tomorrow is the Jackson Hole Symposium. Fed Chairman Powell is probably going to deliver the most important speech of his entire tenure tomorrow, and the markets are hinging on it. And I'm gonna say a couple of things really quick regarding that before I go into the charts and we go into the analysis. The question that we have to ask ourselves, as the Fed Chairman Powell tries to prepare the market for what the markets probably already see coming, is, going to keep rates for an extended period of time, going to let inflation run a little hot, probably over 2%, if they can achieve it. And, the question is, has the market already priced this in? Well, if you look at the S&Ps, I have to imagine yes. And I have to look at the NASDAQ and go, yeah, I guess the market has already, for the most part, priced that in. I personally, in my right mind, can't be just getting long equities right now at this point in time, especially with the NASDAQ at the 161% extension of the post-pandemic move. That's the post-pandemic move right there. I can't possibly be just, initiating new long trades here. But what Fed Chairman Powell says tomorrow could have the ability of continuing to push the markets higher, especially over time. The question is, are we going to be able to, extend and hold gains following any comments that you could arguably say the market already sees coming? So, and one of the reasons why we're up here. And then, you look at the S&P and go, well, the risk, in my opinion, is, we get a buy the rumor, sell the news type of event tomorrow, and the market turns lower, and we get a false breakout on the S&P, and the NASDAQ really rejects the big 161% extension. You know what I mean? That's how I'm viewing it right now. I think that, like I said, the bigger risk currently, and you're seeing it in a lot of different currencies. Now I'm gonna I'm going to share with you something that I use quite frequently and on ForexAnalytix really quick. I'm going to share with this tool that I use. And I don't know if I know a lot of you guys are ForexAnalytix subscribers. You use the tool that we have here. But one of the tools that I find extremely valuable is this one right here, is the risk management calculator. So let me give you an example. So, if you guys, don't know, I've got some dollar Canadian longs, like core position longs, but I'm really, really looking to be more aggressively long on a break above this channel resistance. That's like the key for me, right? This channel resistance right here. Oops, I keep grabbing the wrong thing. Dang it. Okay, let me grab this. This is what I wanted, not this. Okay. So, channel resistance comes in, looks something like that. Okay. And let's say the breakout point, I'm just going to say roughly is 132.70. Okay. So I'll go here 132.70. I'll say my stop loss is 131.30. And my target is, 38% retracement of this move comes in at 137. Okay. Okay. And then what I'll say is my position size. So my position size, let's just say I'm going to round it out for just easy purposes for you guys, $1 million in currency. So my loss, if I get stopped out, is 10 grand. My reward is 32,000. Okay. And then, I can make the adjustments from there and say, my cost average is 132.70. I've got a, $2.5 million position. I'm risking about 26 grand to make 80 grand. Or, I have a 200,000 position and I'm risking 2 grand to make, 6,400. So those are the types of calculations that the risk management calculations that I do, and I use this tool all the time when I'm trading. Here's another example. Like here's the Aussie yen. Okay, now the Aussie yen, just so you guys know, I'm so irritated at this because I'm short, but it's ripped right up into resistance, and I didn't want to be too aggressive ahead of Jackson Hole, but I'm more irritated that we might have a false breakdown here. But I still don't know where my risk is. My risk is above 78, right? So let's do this. Let's say my cost average for, let me see, I'm sorry, 77. My stop is at 77. My trade is at 77 or 76.20. And my target is at 74, roughly. And then it gives you your stop, your risk and your profit. And let's just go with $1 million in currency. So I'm risking 10 grand to make 28,000, roughly. Now, 10,000 risking 28 grand. But since my currency is in Aussie dollars, okay, since it's an Aussie dollar, because this risk management calculator bases your profit and loss off the base currency. So that means if I have, let me go over to my calculator here just so I can show it to you guys. So here's my calculator. If my risk is $10,000, I just multiply that by 0.72. And my risk is actually 7,200 US dollars. So that's how I, and same with profit. My profit might not be 28,000, might be closer to 20 based on the exchange rate. So this risk management calculator is always based off the base currency, no matter what, what you're doing. So I use that calculator all the time. And I thought I'd show it to you because I'm not sure if you guys know the power of that. And this is where pre-planning your trades really comes in beneficial, in my opinion, is this risk management calculator. Okay. Anyway, I think I was thinking to myself, I really wanted to go over that this morning because the market's super quiet, right? It's super quiet, and this gives you an opportunity to kind of look at you know some of the different features that you might be using when using ForexAnalytix. So what we're going to go into is the analysis, and I got a couple questions like from Martin says it's a trap. Yeah, that's the thing about the equity markets. I personally think by the time Friday is over, the S&Ps are going to be back below here. I personally believe that. I think it's a buy the rumor, sell the news. Every bank, every analysis that I've gotten, expecting a dovish Fed, expecting a dovish Fed. Like here's a great example. Let's see if I can show it to you guys. All right, this is Citigroup, for example. Jackson Hole dovish review, because it's their framework review, right? I mean, everybody's expecting a dovish Fed. Everybody. So obviously the market's where it is. Okay. So the question is, as we get a dovish Powell tomorrow, will we spike up and spike back down? That's what I think is going to happen. So the question is how far this goes. Let me go into a 4-hour chart with the S&P. It'd be a little easier. So the question that I have now is, how far higher do we go before lower? That's the question that I have. That's how I'm trading it. That's how I'm imagining what happens. Now, does that mean that I'm going to be right? No, not at all. That's what I think is going to happen. Like I said, doesn't mean that that's going to happen. It's not, there's no guarantees of that at all. But I think the market is really, really, is already priced all this in. Okay, so let's talk about currencies, and let's get everything up on the bias chart. And by the way, I'm going to start with gold first, because you want to know one thing that's going to tell me if the market's ready to turn around or not is gold. And I look at gold, and we're very close to this trend line here, which comes in at now 1910. Right now, gold may break down today. It could break down. It could break down today, but I just don't think it's going to. Well, even if it does, it's not going to mean anything. But what I'm seeing here is that if gold really starts breaking down tomorrow, that's going to be an indication, in my view, that that the stock market's probably going to be turning lower. But what we should see tomorrow is dovish Fed. We probably spike up and then back down. You know what I mean? Dovish Powell is what I meant to say. Let me delete this. Why is my delete button not working? Okay, it's working. All right. So resistance for gold. I think what we had down yesterday is probably valid. 1960. It's bullish for now, right? It's bullish for now. Man, this euro is getting clobbered. Speaking of the euro, let's go over there. So, like I said, weak euro, false breakout. In my opinion, euro is going back to 115. Today, no. After tomorrow, possible. All right. I think the euro is going to trade. This is one of those situations where we get a dovish Powell, euro spikes up to 119 and then lower. That's how I think it's going to happen tomorrow. From these levels, I don't know. From down here, maybe smaller bounce. Hard to say. Support 117.50. Trend line support here is going to be 117.40. So I'm just going to write down, same numbers as I did yesterday almost. 117.10, 117.40, which would be this trend line right here, right? Okay. And 117.10 is right here. I guess we can just write down 117, but that low is 117.10. So, I mean, probably, oops, write this better just to keep it even. Resistance. So yesterday we stopped up at that 118.50. So I can imagine that that's probably good resistance. 118.50. You know what I'm saying? Okay. That's what I think. Let's see. Cable. So the pound, I think we're in no man's land right now. While we're below 132 and above 130, but support right now is 130.60 or 130.50. This is still bullish for now. We're range for the cable. We are capped right now at 131. What is this? 618 comes in at 131.80. That's it. 131.80. Okay, we might get up there this morning. Then this might not be a bad area to be on the short side of the cable. Right here at the 618. Here, let's delete this really quick. Get rid of that. Okay. Up here at the 618, let it just hit brief new highs. Let it just hit new highs at 131.80 and then tag it. Aussie. Still range bound. Frustrating as it is. Support 71.35 still. I'm going to, I know I've had this in as bullish, but man, we are really on the verge of flipping to range here, and it's hard for me to be bullish the Aussie when it's just not going anywhere. 618 is 72.25. I'm going to put it on range for now. And same with the Kiwi. As you guys know, the Kiwi is, we're above the 65 or 64.90 support, but we should find resistance anywhere close to the 66 cents. So okay. And I have to put this, as you guys know, this is where Aussie turns bearish, is if we break 70.75, it actually turns bearish, because that is, wow, the euro is just getting absolutely butt wiped right now. I think a lot of people probably, ECB, Schnabel says that there is considerable uncertainty as to the precise level of the reversal rate, and current estimates suggest that ECB has not reached the effective lower bound. Wow.
Race.
Yep. What?
It's a race to the bottom.
Yeah. I'm going to have the dirtiest, weakest currency on the face of the planet. That's what it feels like, huh? Man.
Yeah.
Yeah. Well, let's see if we can. That's the scary thing about tomorrow, as I've been saying, Stelios, is, everybody expects it. Everybody expects the Fed to be dovish.
Yep.
I don't know, guys, if you've seen it, but the dollar is not acting horrible. We've had it's bearish, but it's already been bearish. We have a false breakdown. I think the risk is the dollar starts to scream, you know?
And it's
Now,
well
obviously,
well overdue for a correction, that's for sure.
yeah, I mean, here's like the longer term, you know, can we bounce back to 96 from, 93 where we're at 93? Can we bounce back to 96? Sure. You know, and I guess if you really want to look at like this trend line here, you could go. That's not what I want to grab this trend line here. You can actually go right to that little spike low right there. And in essence, we, never broke that trend line. Yeah, I try to go through as many points as possible here on these trend lines. So, I've got it as we broke it in the past, but man, I don't know. Maybe we didn't. Maybe what this is telling us is, we're going to be bouncing back and re-challenging this other broken trend line. I'm just telling you guys that being short the dollar right now has been a very frustrating game for those people that have been expecting, Powell to be dovish. I think that if the dollar sells off tomorrow, following the Jackson Hole thing, if he comes out, says everything that the market is already expecting, then as the dollar dips, you probably have to be a buyer, is what I'm thinking. But that's just me thinking out loud at this very moment. All right, let's go back to the Canadian really quick. And then I'm going to let Steve and Stelios take over here. So support for the dollar Canadian is 131.30, as you guys know. 131.35, I guess. It's important. Why? Because see this dotted line here? It's just a retest of that trend line here, 131.30. Okay, that's a weekly. It's 2016 highs to current, right? So we're just like hovering around those levels here. And below channel resistance. That's why I have 132.50 as big resistance, because that's the channel resistance. I doubt we get above that today. Matter of fact, if we get anywhere close to that today, it's probably a decent sell going into tomorrow. But I'm just, I'm just saying. Dollar Swiss. Triangle. Holding. 90.70. 91.30. Tightening. It is still bearish while we're below 92.40, which is actually like 92, well, it's 92.50, 92.40. Remember, this is a broken weekly trend line here. Okay. But still, while we're below, like 92, 92, 40, 50, it's still bearish. It's just, we had a false breakdown triangle. We could reverse here. So just keep that in mind. Perfect consolidation though. Perfect triangle consolidation right now, as annoying as it is. Dollar yen. What a rejection overnight. We really rejected the 76, 106.60 channel resistance. Okay. Big resistance up there. Support intraday. I like the 106 level, but really key support's going to be 105.30, as you guys know. Intraday, we should see some support there. Dixie, dollar index. Resistance, 93.50, 93.45, then 94. We're still in a bearish trend, but we are at risk of turning back to range. Remember, false breakdown, nice little wedge developing here, if you will. Yesterday, our support was at 93, if I'm not mistaken. Double check that. I think it was. This is the bias chart from yesterday. Coming today. Wow. I got the blue wheel of death on a picture, which is really odd. Okay, I'll come back to that. So 93 will be support again today for now. Go to dollar max. Okay. 21.84. Still just holding down here. Resistance intraday is going to be, we're going to write down 22.05, but $21.84, 22.05, then 22.30, okay, which is really this resistance up here, okay, so dollar Norwegian krona, still holding above this broken trend line, support 903. Now that this is dropping, I should probably say support is a little lower than that now. Support's at 890. Resistance 905, I believe. Let me double check that. $906. And then really it's after that it's 920. Just so you guys know. We went from bearish to range. And like I said yesterday, you notice how everything why did that not, hold on guys, let me my bias chart didn't come up right. It's weird. Okay, there, that was from yesterday. Okay, I don't know, the first time around didn't show up well. So from yesterday, what was the number that I was looking for? I think we were doing the dollar index. Yeah, 93, 93.50. Today, 93.45 and 94. Gold. So S&P, probably the same thing. Let's take a look at the SPOOs.
Blake, we have some data in about 25 seconds.
Data, have a break.
Data Schmeda. Who cares about data? I don't care about data. I mean, does anybody care about data right now?
No.
All right, thanks, guys.
Unfortunately, you're right.
Yeah, I mean, durable goods, it's probably not going to move the needle. I'm actually here. I'm keeping it on S&Ps here. The reason why is because No one cares about anything but the S&Ps right now. So, and then, which is great because I'll just do analysis on it really quick, and then I'll pass it over to you guys.
Oh, that's a lot better than expected. Yeah.
Yeah, much better than expected.
The revision's higher as well.
And you can see the dollar is doing nothing. Not a thing.
Yeah, even metals, they're not moving that much.
Gold's coming down. Gold just broke 1910.
Yeah, gold had been drifting low before the numbers, but yeah, you're right.
Yeah, we were sitting right on support, and now we are risking a break of this trend line that's been in existence since March 20th. The lows post-pandemic move low. So that's a big deal. We're really right on it. I mean, you know, you can argue that we're on it now, I guess. This is actually probably more valid, right where we're at, 1900, whatever it is, 1905. Look, I'm not trading gold here because I think the risk is it's going to break down. But intraday, if you want to buy it, if you're a buyer, this is the place to be a buyer. I'm just saying, from a risk reward perspective, I'm not buying it, but I'm just saying, you know, I'm just throwing that out there. Okay. I'm going to just do the S&P and then let you guys take over. So where's the S&P? Let's just do this. 3,400. We have 3,425 and then 3,400. So 3,400, 3,425. And we are in a bullish trend. And resistance, what did we write down yesterday? 7,000? 70,000. Okay, 70,000 is resistance on the S&P. 261% extension of this last little leg. Comes in at 3478, I think it is. Yeah, well, that's it. Okay. 3478. So there you go. There's your bias chart. This is your bias chart from yesterday. This is your bias chart for today. So there you go. Steve, Stelios, look at the euro is just getting absolutely creamed right now.
Yep. Sentiment and positioning had been at extremes for a while. Where was, let me just check DSI.
Should we be surprised?
Well, we've said it before, you know, there's always going to be a correction. The question is what's going to trigger it. And, you know, I think what you said about Jackson Hole and about what the market is expecting, and everybody expecting basically the Fed Powell to be dovish, and everybody's the same way. So, you know, I think path of least resistance is probably for the euro dollar to go lower, so the dollar to strengthen.
Yeah, you know, I think that the false breakout of the euro is really going to weigh on the euro. I think we trade back down to 115. You know, but what probably, and I know I said this a little earlier, Stelios, what's probably going to happen is we're going to see hear from a very, very dovish Jerome Powell tomorrow. And what will happen is the euro is going to find some support down here today, somewhere down here. We're going to get a very dovish Jerome Powell. The euro is going to spike up. Dollar's going to weaken. It's going to fail to make new highs, and then that'll be where it rolls over. If I had to guess what happens with the dollar, would be my expectation, I think. So anyway.
Sounds reasonable to me.
Yeah, I mean, you know, we'll see. But tomorrow's obviously very important. So how are you doing today, Steve? How are you doing?
Good, mate.
All right. Well, I've got the bias chart all ready for everybody, and I'm going to pass it over to you guys so I can give you an opportunity to talk a little bit, since Dale's not here, and he's not going to be here until tomorrow. So
yeah, he's going to be back with us tomorrow. Indeed.
He's skipping the most exciting day that we have right now.
Yeah, unlucky him.
so anyway, what are you guys looking at today? I mean, we're it's a day ahead of Jackson Hole here. What do you have going on? What do you think? What do you think's going to happen tomorrow? What do you think? Give me you guys each give me your opinions on where you see a Fed Chairman Powell, what he's going to say, and B, what do you think the market reaction is going to be to that? I think he's going to be dovish, but it's already priced in. So,
I think your take is spot on. Is exactly what I would have said. I think he's going to be on the dovish side. Maybe there's a chance he might not be as dovish as people expect. Remember, there seems to be at least good recovery in economic data, and even though unemployment claims are still, we're getting 1 million every month, but PMIs and retail sales and all that, they're bouncing. So he may mention this. If he does mention this, then that's not going to be, I think he might not be as dovish as expected, but he is going to be dovish, that's for sure. And I think that the risk is for the dollar to start strengthening. That's my view. I think risk reward to be long dollars here is a bit stretched. So I agree. Unfortunately, I agree with you, and I have not much more to say.
all right. Well, I mean, I look at some of these markets like obviously, we have new highs in the Nasdaq. We're new highs here, but the Dow is really kind of struggling. The Dow is failing to make new all-time highs. The S&P's marginally higher than its previous highs. We're at all-time highs, but risk of a false breakout, I think, is there. And so those are things I think we need to watch. So Steve, what's your take on Powell tomorrow? How the market's going to react?
First of all, the main reason that the Dow is lagging is definitely the fact that it underrepresents technology companies. Yeah. And we all know that the momentum stocks have in the vast majority been tech stocks. So this is one of the main reasons why the Dow lags. And I think as long as we are in this mentality and environment, it's not easy for the Dow to actually start pacing in the same way that the Nasdaq and the S&P do. Having to do with Powell, I do think we're gonna get a path forward that's going to clearly show the tolerance of the Fed for more monetary insanity and targets about inflation, the labor force and employment and all that. But as you said, can the market react higher in risk assets? Can the market react lower in the dollar? Yes, of course it can. But where's the risk reward at the moment? I mean, just buy it here and have your stop loss where, and hope that how much higher can it go. So in my opinion, somebody's either flat here, having to do with risk, or if you're long, just protect what you have, because you never know. I mean, sometimes the market runs a lot ahead of itself, and even though we are in a confirmed uptrend, the market might find a reason to be a little bit disappointed, and that might equate to some type of a short pullback, sharp pullback, because we know that this type of market produces only two types of moves. One is like this slow grinding drift higher, and the other one is like sharp moves to the downside.
Sanse asked a good question. Steve, do you believe that we can have growth without inflation? No justification for inflation to produce growth?
I really don't understand the question. What kind of growth are we talking about? Because first of all, let me answer the question with how I understand and economics understand growth. Growth and technological advancement produce, and I've talked about that multiple times, deflation. Growth and technological advancements never ever produce inflation. They actually produce deflation. Increased productivity produces deflation. Just the Fed and the rest of the central banks try to persuade people that inflation is a natural product. And now by inflation, I mean price increases, right? Because the traditional definition of inflation is the expansion of credit and money supply. So if we're talking about inflation having to do with price increases, we know very, very well that productivity growth and technological advancements produce the exact opposite. Now, the Fed and the rest of the central banks want to, despite that, push the needle so we can have a positive inflation. Why? Because we have debt that is completely unsustainable at the moment, and then there is no way forward other than two options. Option number one, just admit that the current situation is unsustainable and everybody make common sacrifices to, in essence, make a generous haircut to debts, or the dishonest way, which is try as much as possible to inflate debt away. So yes, I do believe that we can have growth without inflation. I actually think that growth brings disinflation.
All right. Well, there you go. So disinflation. So if we're going to have in a disinflationary environment and not inflation, so how does the Fed chairman actually generate or conjure up inflation?
They do it at the source. I mean, don't forget that until like 10, 15 years ago, it was a common understanding of, between almost everybody that was in the world of economics, that, as Milton Friedman has said, that inflation has always been and is a monetary phenomenon. So the Fed actually conjures inflation because that's the only thing that the Fed can do. And now I'm referring to the initial definition of inflation, which is the expansion of money supply and credit. Now, many people wonder, okay, if that is the basic definition of inflation, then why, after conjuring so much money during the past 12 years, haven't we seen, that much of a price increase? The answer is, and I've mentioned that in the past, first of all, the answer lies on two things. First of all, we have what we call the Cantillon effect, which is that usually the effect of liquidity is more prominent where you inject that liquidity initially. In this case, we know that quantitative easing is injecting liquidity at the top, meaning at financial assets. And we know that not the whole population owns financial assets. That is why inflation, at a big extent, has shown its effect in asset prices and not so much in everyday prices for what we buy every day. Having said that, it has an effect on that prices as well, because we do know from hundreds of years of financial history that we would probably have a negative inflation if it wasn't for that. So it spikes price increases even there in everyday goods that we all buy, but it's not that much apparent because we've been indoctrinated to believe that having positive inflation is a good thing, is a natural thing, while it's quite the opposite. That's a natural thing. As I said before, productivity and technological advancements always create disinflation. Take as an example prices of computers, prices of televisions, and everything else. Trust me, the same type of technological advancements would have created, for example, decreasing prices in food and everything else we consume, but thanks to the monetary authorities, that is not the case.
All right. Well, Steve, I'm going to let you go through, what other assets you're going to go through and with Stelios, and I'll catch you guys on the daily roundup here in a couple hours. And watch this euro. Euro looks like we could trade back down to that 117.50 support here this morning. So be careful out there.
Yeah. We're still range bound, but as you said, Blake, I mean, perhaps that was a false break higher, and if that's the case, And if we do break below 117 change, I think we're going to be looking for a deeper corrective move lower, unquestionably.
Couldn't agree more.
Thanks, mate.
Thank you, Blake.
So
Thanks,
still,
you know, Steve, I was going to add to what you were saying that consumer price inflation is really what you put into the formula, and they've changed it so many times. And that's why we see asset price inflation and not, you know, product, let's say, inflation, because they include and put heavy weight on electronics, which are negative, which are deflationary, and they don't include other stuff like, you know, healthcare and education.
Of course, we've talked about that a lot of times.
Exactly.
Unfortunately, they've even changed the way inflation is being calculated for more than obvious reasons. And for people that listen in, those of you that don't know, listen, changing the way you calculate inflation to underestimate it is extremely, extremely important and has you know, a huge effect in almost everything, because it's not just that you make people feel that their cost of living doesn't really go that much up, but keep in mind that it even changes what we perceive GDP growth to be. Because don't forget that when we calculate GDP growth, what do we say in essence, in very simple terms? We say, okay, how much did the economy produce last year? X. Okay. How much did the economy produce this year? It produced Y. Okay, but I have to compare this year's Y with last year's X. So what do I have to do for that? I have to deflate Y to bring it back to prices of X period of time. So if you actually underestimate inflation, besides the first effect that I mentioned, what you also do is, in essence, you overestimate growth, because you deflate this year's growth by a smaller number than you should actually deflate it to compare it to last year's growth. So in essence, you kill two birds with one stone.
Yeah, absolutely. Yeah, and imagine what would have happened if all this QE and you know, stimulus hadn't been done. Obviously, it did help initially in the 2008 crisis, but all it's done is it's inflated asset prices, you know, housing and stocks and bonds, which are owned by a small fraction of the population. So it's a long conversation, let's put it that way. But let's see what the Fed can actually do, if anything.
Jason says that Fed's balance sheet has been dropping, which is true. But my question to you, yeah, but my question to you, Jason, is the following. First of all, I wouldn't exactly call it dropping. It's like, you know, how do you have like a very bullish trend in a chart, and then, you know, the trend has to take a breather, and it's like, you know, a little bit of a consolidation, just, you know, a minuscule pullback before you get another leg higher. I don't assume that you believe that the next leg for the Fed's balance sheet, or as a matter of fact, for any other major central bank, is going to be to the downside, right? Because, you know, I'm more than willing to take the other side of that bet. More than willing. I mean, yeah.
Okay.
I bet you that we're going to be at 10 trillion, and I can openly say that. My assumption, Stelio, is that we're going to be at 10 trillion maximum by the end of 2021. That's my personal assumption.
Yeah, I don't disagree with that. So what else is there to say? Like we said, very quiet ahead of Jackson's Hole. There's also something which needs to be taken into account. Hurricane Laura, which is strengthening, and the main issue is that it's going to threaten oil production. You know, some refineries in the US might be shut for a long time because of that. So that's something just to keep our minds on. But other than that, it's been very quiet. Data-wise, we had nothing, just these durable goods and GDP out of Mexico, which came in a little bit better than expected, but still minus 17% quarter on quarter. Yeah. So I don't think that's going to do anything. So
speaking of which, the USDMXN has been consolidating in in this triangle for quite some time. It's now like poking its head a little bit below the triangle, but I wouldn't really trust that much any type of move that happens today for reasons that Blake covered since the very beginning of the webinar. So I wouldn't definitely be treating this like a breakdown or whatever. I think the market is going to be in hypnosis, until we finally get what we're going to get from the virtual Jackson's Hole.
Yeah, our friend Jay is actually asking how Hurricane Laura is going to affect CAD. Well, I think it's theoretically, if oil production is disturbed and reduced, then obviously currencies like CAD and Norway and commodity currencies, the commodity currencies are going to probably rally. That's what logic says, but logic has gone out of the window a long time ago.
Yeah, that's very true, actually. Somebody has shot economic logic to the head for the time being.
Yeah.
Stelio, Jason asks, how does QE boost asset prices since it's an asset swap?
Well, the way QE works is that the Treasury just buys, they start with bonds, they start with anything, and the net effect is that obviously money supply gets increased, the excess reserves on bank, the bank excess reserves increase as well, and so the trickle down effect that they claim can happen and go down to the average Joe actually stops quite high, because all that happens is that bond prices go up, and you have other central banks like Bank of Japan who are actually buying equity ETFs. So you just have equity and bond prices rising. And like I said last week on this webinar, or was it Monday, that I read somewhere that 80% of the US stocks are held by 10% of the people.
And Stelio, in my opinion, which is also the worst, if you ask me, there is also the indirect effect of how they use QE that does a huge damage to the actual economy and increases the fragility of the system substantially, if we want to look forward into the future, but also, in essence, boosts asset prices, which is the fact that they have, in essence, more or less transformed, or they are seriously trying to, in essence, transform every single asset to a risk-free asset. So, in essence, they provoke the mentality that, nothing can fail. If it's big enough, nothing can fail, because nothing will be led to fail. So, in essence, they provoke animal spirits in the sense that you can go and bid anything that actually produces a decent, for today's standard, yield, and don't worry about it, because there's no chance we're going to let it fail. Look at what has happened with, look at the huge distortion, for example, and the moral hazard in the junk bonds market. Just to give you an idea, as you very well understand, the junk bonds market yield has always been, very closely correlated with bankruptcies, right? It makes sense. I mean, the more companies in that sector that go bankrupt, the higher the yield, right? Now they have even managed to decouple that. Due to COVID, we have a lot more bankruptcies, of course, in the junk yield sector than we've had normally. I mean, a lot more. And junk yields, after their initial reaction higher, and after the very initial stages before central banks intervened, it has now come down, irrespective of the fact that more companies in the sector are going bankrupt. So that's how all of that works, and
yeah, and when the theoretical risk-free rate, which is government bonds, is zero, then you try to get yield anywhere you can. That's why you have junk bonds trading at 3-4%.
Yeah, which is a joke. I mean, you couldn't get safe assets with that kind of a yield like 15 years ago.
Yeah. 10-year US would have been a gift if you could get it at 4%. Yeah. Anyway, okay.
Okay. Anyhow, it's not a bad thing. I mean, today we have we have had time to speak about stuff like that today, since there's almost no movement in the markets. So let me go through some of the questions and see. Actually, more of a discussion from here. Hey, Steve, the 10 trillion you mentioned by the Fed in 2021, are you thinking 2021 only or with 2020? No, I mean the total balance sheet of the Federal Reserve, I think, is going to be easily at 10 plus trillion by the end of 2021. It's currently roughly at 7 trillion. So, what in essence I'm assuming is that there's going to be another 3 trillion at the very least, by the end of next year. So somebody's asking about platinum. Yeah, sure, we can have a look at a few of the charts. Platinum testing these channels, trend lines support once again. Even if we break lower, I wouldn't be chasing it because, as I was saying, as we were climbing higher, 875 is a key area of support resistance. So, to be honest, as long as we trade above 875, I wouldn't really be, turning short. Platinum, palladium, very long-term consolidation now. I mean, we peaked in the end of February, and since then we've actually been producing this symmetrical triangle, which is a possible, I don't think a very probable, but it is a possible scenario of what can happen in gold and silver here, right? I mean, they might end up correcting in price, but there is also a chance that they will be correcting their recent gains more in time than in price. In any case, if gold makes the next move lower here, 1815 is the next area of support I would be looking. I wouldn't even rule out a move down to 1750. Having said that, my long-term bullish bias isn't changing. Even if we go down to 1750, you should actually more or less consider that a gift if you can get gold at 1750. More or less the same applies in silver. 2480, I mean 2450 to 2480 is an interesting area of support. Below that we have $23. Below that we have $21. Below that we have $19. As long as we trade above 19, which I very, very much doubt that we're going to see again, I have no reason to change my bullish bias. I think, the closer you can get to $21, the more you can consider that a gift having to do with silver. Personally, I will consider it a gift. I don't think I'm going to be that lucky to be able to buy silver at 19, but who knows? Perhaps we get lucky and we can buy it at $21. Keep in mind that silver, despite the recent explosive move higher, has traded twice in the past at $50, and I think it can actually very, very easily do it again. And I actually think that the next time it's going to be trading at $50 is not going to be another high to form a triple high. I think, third time is going to be, the charm. So I think the third time we'll actually manage to penetrate through it, and who knows what kind of a high we can find. As platinum is correlated to gold, you mean? It has some correlation, yeah. Of course it has some correlation, but on occasion, it's not that good. I mean, it used to be much, much better in the past. Of course, the US dollar component is common in both of them, right? So whenever, whatever part of the move is coming due to dollar strengthening or dollar weakening, of course, it's common between the two metals, since we're denominating them in gold in this case, right? I mean, if you say gold or if you say silver and you don't make any specific, a mention to another currency, you always mean denominated against dollars. As a rule of thumb, in September month, dollar goes way up. I'm a layman. I don't know all technicals. Foreign students will come to USA. People from world come with money within one category. Banks across world provide Black Friday orders, liquidity in dollars. Yeah, all that makes sense, mate. But if you read one by one the reasons you mentioned, you will realize that especially under a COVID environment, all of them are not going to be that strong as other years, right? So the effect of everything you mentioned should be significantly lower, specifically this year, due to COVID, partial or full lockdowns, big part of the population being scared. Many universities will not be opening and will be doing virtual classes, so on and so forth. Gold ETF GDX. Good. Yeah, it's fine. I mean, supposedly it even has like, the assets. I personally have said it many times. Gold is a metal that can be stored very easily because it has a high value per ounce. So if you're talking about a long-term investment, especially having to do with gold, I would much rather have the actual tangible thing in my possession than some ETF that promises that will actually pay you if you want, redeem you if you want, what you own in the actual metal, because I consider it very likely that if at some point we have a big squeeze, the vast majority of these assets are going to be cash settled. Thoughts on oil and natural gas? Yes, natural gas has now even sliced through my target and the rectangle's target. I'm now out of this position. I made slightly more than 20% in this, so it was a great trade. I don't have any regrets that I got rid of that position. Since the very beginning, I had a very specific trade in mind. I had already put in the rules of how I wanted to trade this. It came into fruition, so I'm perfectly fine with that. Now, I see no reason why this can't even extend to $2.9, right? $2.9 is the next really big area of resistance. So, as long as we trade above 205, this seems to be a very legit move, if you ask me, and I see no reason why I should stop, right here, right now. Having to do with crude oil, as you see, the situation with crude oil hasn't really changed. We're stuck in this ascending triangle. I still think it's a possible scenario that before we see a deep corrective move lower, which is well overdue, that we might see a spike higher that will probably trap people in the wrong direction. So, bottom line, my thesis here is more or less equivalent to my thesis having to do with US stocks, which is, I wouldn't be fading it unless it breaks down from this technical formation. But on the other hand, I'm not willing to buy with risk reward being as bad as it currently is, right? So I'd rather watch it and let it do its thing. I might consider selling it if it breaks down from here for a short to medium term move lower. I can easily see it going back to $29. But in general, since my thesis and my bias for the dollar is long-term bearish, I do think that any deep pullback in crude oil is probably going to produce a buying opportunity, right? I'm puzzled by pound yen lately. Can you look at it? It looks like there are risk on, but it may rip soon. Okay, so having to do with the gappy, here it is. What I see here is a short-term consolidation. So, in the short term, I think there is a very high chance that it's going to get resolved to the upside, because usually, triangles get resolved in the direction of the previous move, in which case it's higher. Having said that, I would pay close attention to the larger channel in which we trade. So even if we break higher, I think, you know, the closer we start getting towards like 144, 145, you should start paying very, very close attention. That's what I think about the pound yen. Now, it's in general, I've recently avoided yen pairs pretty much altogether. And the reason is one, and it's mainly this. It's the USD yen, because USD yen has been an abomination, right? It has been extremely tough to trade because it has decoupled from anything that it was traditionally correlated with. And on occasion, it has produced multiple false breakouts since the beginning of this year, like February mostly, and forward. And I think that as long as it's extremely hard to read what the hell is happening with USD yen and where it's going, it makes me a lot more skeptical in wanting to trade anything that has the yen in it. So that's my personal point of view. I'm monitoring like more than 50 markets, and I find no reason to push myself in trading some of them whenever I have no clear understanding of what the market wants to do. Okay, last question that I see here about Bank Nifty, and then we're gonna wrap it up and talk about it again tomorrow. Bank Nifty recovering in what seems like a big channel. In general, as I've said multiple times, anything that has banks in it, stay away from it. The bank business model is, under this current environment, is bound to fail. Of course, they're going to keep banks afloat, but that's not enough to make them really overperform anything else. So I think that this formation is going to eventually get resolved to the downside. Watch this channel trend line resistance, which roughly comes at the moment at like 24,500. And I think the closer we get to that, the better the risk reward is to be short. Anyhow, thank you everybody. Tomorrow should prove to be a very interesting day. I think we're going to get a decent amount of moves that will keep us busy for the days and weeks ahead following that, at least hopefully. So everybody have a wonderful day and see you again tomorrow.
Thanks, Steve.
Thank you, mate.